Welcome to my YouTube channel. Today I will talk about Star Investor investment strategy. The benefit of this video is that you will be able to do stock analysis in order to pick the right stock to outperform the market. That's a strategy that the fourth richest man in the world is doing. In short, it helps you to make good money in the stock market. Comment below where you are from. I'm curious to know where my audience are watching from. Subscribe and hit the notification bell so that you don't miss any upcoming investing video. Without further ado, let's get started. Warren Buffett is a star investor. He's one of the best investors and he's the fourth richest man in the world with a net worth of 68 billion US dollars. That's a little bit difficult to imagine, but if he spends 1 million US dollars per day, he will run out of money in about 186 years. He made his money from the stock market and he is able to make a yearly return of 20% consistently in the last 50 years. Of course, there's a strategy for that, so let's have a look at it. After that, we'll do a case study. This strategy is to buy quality company for an undervalued price. As simple as that. There's a method behind it. To be able to find out good quality company, you have to understand the business first. That's why he said that you shouldn't invest in a company that you don't understand how it makes its money. That's why the dot-com bubble happened in the past. At that time, investors invested in any IT startups without actually knowing what it is doing. Of course, at the time in the late 90s, it was difficult for people to understand IT because it was a new thing. Like nowadays, 5G and AI is also a new thing that will dominate the world in the upcoming decades. That's why he looks at the company, how it makes its money. The easiest way to do that is to look at their annual reports. And that's also why he just invests into public traded companies, because only these companies have to do annual reports. Then he looks at the company competitiveness of the company to find out how stable and sustainable that company is. On top of that, he looks at the management of the company. The management of the company is also very important. The company can fall or fly just because of the management. It happened to Apple when John Scully became CEO of the company. Apple almost went bankrupt. It was thanks to Steve Jobs who became the CEO of Apple again, and from there on the company started to make much money again, and it is one of the most valuable companies in the world now. Once he comes to the conclusion that it is a good quality company, he then started looking at the stock price. He only buys undervalued stocks, which means that the stock price is lower than the intrinsic value. There are many ways to determine the intrinsic value of a company. So let's continue with a case study. So for example, let's have a look at this company, AbbVie. So let's see what it's doing. It's doing in science, okay. It does therapeutic focus areas, immunology, oncology, neuroscience, biology, general medicine. Okay, well, I'm not a medicine expert or something, so I don't know exactly whether these kinds of products or services this company is offering is in demand. I mean, like biology, before the pandemic, I assume that it is not that in demand, but right now of course it is. But who knows how long this company will last and how good money it makes. So this kind of company I personally don't invest in because I'm not sure how well it does. I mean, all the products and services they're offering, I'm also not into that and also don't know much about it. So that's why I don't invest in it. Next, for example, Microsoft. Well, I would say everyone or almost everyone know what Microsoft is and what it is offering, like Office, like Microsoft Word, PowerPoint, and also Windows, the Windows or like Windows 10 we are using right now. So yeah, everyone knows what it is doing. It is a public traded company. You can buy shares from them. They also offers many other services and products, not only software but also hardware like Xbox or Surface. So they are well diversified. They also offer cloud services. So yeah, with that many kind of product lines, they are able to make money in different industries. So yeah, that's about the company. Okay, I do understand the company. Then next, competitiveness. So this company has like a market share of 90%, which means that its product is so good everyone wants to buy it. So their competitiveness is they offer good products and services that everyone wants. So that's why no one can compete with them. That's why they have a market share of 90%. What about the management? So the management right now, the new CEO came like in 2014, the CEO Natadella, and after he became CEO, the stock price surges. So let's have a look here, like 2014. As you can see here in the graph, 2014, it's about here. So at that time it was like $45 per share, but since he took the office, since he became CEO of the company, the stock market surges. So it's a good indicator, or it is the indicator that he's doing something right. So he's a good manager, the company is doing better, they're doing more profit. So yeah, that's a proof that he's doing well. The management is good. All right, okay, we have determined it is a good company, good quality company where you can invest in, where the company also like lasts like in the next decades or so, because you can see here they already last like many decades, like since 86. And yeah, they're doing great right now, they're also doing great later. We can also see, to know more about the business, we can also look at the earnings report. So here we can see the profit they are doing. Operating income increased by $2.7 billion. So they make a profit, and it is an increase according to them. So the income increase. So let's say the net revenue, sales, marketing. Where's the net? There's net income. Operating to gross margin. Research, general gross margin. Okay. Let's have a closer look at their financial statements. How much profit, how much money they make, we'll see. Alright, so this is their revenue, their sales. They did like 2003 months ended in September. Okay, that's 2019. Quarter earnings release. Yeah, so last year they didn't make a good money. Here's the net income of 10 billion, around $11 billion in profit. That's what they did. So yeah, they're doing well. Let's have a look at the annual reports real quick to know more about them. So last year, the whole year they made like $39 billion. So yeah, they made like $125 billion in sales, and out of that they make $39 billion. Yeah, looking at their earnings report, looking at their annual reports, then from there you can understand the business better, where they make money from, how much they make, etc. Whether they have also like debts. That's what also can read from their reports. And it's pretty long. It's like dozens of pages where you can look dive deep in further what they are doing. That's why Warren Buffett prefer public, he only invests in public traded companies. So yeah, like I said before, this is a good company. So now we have to determine the intrinsic value, whether it's undervalued or not. So the real value compared to the market price. The market price, the share, is like right here, about roughly 184 US dollars. So now we will determine the intrinsic value. There are many models, many ways to determine that, but we will do that right now, how to calculate the intrinsic value. So let's do this. So of course there are many models, but this model is called dividend discount model. So there's a formula for that, and then we will calculate whether it is an undervalued company or not, whether we should buy it or not. So P stands for price, so price of the market share. D is the dividend, well, not the current dividend, but the dividend from next year. G is the growth rate of the dividend, and R is the interest rate that you want to achieve. So let's get started. P is equals D1, we have to determine the G. So let's do this. So in the previous year, it was like 46 cents per quarter. 46 cents per quarter times 4. So last year was like $1.84. Okay, let's calculate this year times 4 divided by $1.85. So we have a growth. Wow, we have a growth at like let's say 11%. Wow, that's good. Okay, G is 11%. It's just a quick note, 11%. So D, D. Okay, so that's 4 times 51 times 1.108, roughly 11%. So the next year is an assumption that they will pay $2.26 in that year, and then we will putting it into the formula, and then we will calculate it. So let's say we want to have a return of 20% minus the 11% of growth rate, dividend growth rate, and then we can see the intrinsic value of it. So let's calculate. $2.26 divided by 2.9 equals to $25. So the intrinsic value of the share is $25 according to the formula. So which means right now is 183. So the market price, the stock price is too high. So it's not undervalued, it's too overvalued. So he wouldn't invest in that according to Warren Buffett. So yeah, this is how it works. This is his strategy. And there's also a quote from him. Let's go next. Further. So the quote is, "Just looking at the stock price is not investing," from Warren Buffett. That's what he says. I also have more videos about investing. Just check out the investing playlist, which you also can find in the video description below. Don't forget to subscribe and hit the notification bell so that you don't miss any upcoming investing videos. See you next time.